If you're still fixated on Nvidia's stock chart, searching for reasons to justify a breakout at all-time highs, you're making the same mistake investors made 2 decades ago when they clung to Nokia. This isn't alarmism, it's a lesson in paradigm shifts. Back then, Nokia didn't lose because its hardware was inferior. Its phones were practically indestructible. It lost a war of dimensions. When Apple introduced touch interfaces and the App Store, creating a closed-loop ecosystem, the value of hardware itself was crushed by network effects. Today, the same script is playing out in artificial intelligence. While Nvidia remains a great hardware company, the capital markets have undergone a structural break. We're witnessing a once-in-a-decade capital migration. Liquidity is shifting from a single hardware supplier to platform giants with full-stack ecosystems. One of the world's largest AI compute buyers, Meta, has officially confirmed it will redirect billions of dollars in spending from Nvidia to Google's TPU tensor processing unit architecture. Let's pause for a moment and consider the implied volatility of this move. This isn't just a routine procurement change. It's a top-tier vendor substitution. It's akin to a supreme commander in wartime withdrawing core military orders from a long-standing ally and handing them to another arms dealer with vertical integration capabilities. This is a seismic signal, indicating that Nvidia's once impenetrable moat has been breached from within by its largest customer. For institutional investors, the task is no longer debating whether Nvidia is excellent, but identifying who will capture the new alpha in this paradigm. The answer points to Google and its key supply chain partner, Broadcom. In the following briefing, we'll strip away market noise and dissect this wealth redistribution from 3 dimensions: microeconomic technology, macro monetary policy, and capital flows. There's a major cognitive bias in the market, equating most powerful general-purpose compute with highest commercial value. This is classic engineer thinking, not capital thinking. Nvidia's H100 chip is indeed a performance beast, like a Swiss Army knife, excelling in graphics rendering, model training, and inference. But in economics, general purpose often means redundant. To accommodate all scenarios, the H100 sacrifices energy efficiency, making it extremely expensive and power-hungry. In contrast, Google's TPU is an ASIC, application-specific integrated circuit. It's not a Swiss Army knife, it's a laser scalpel. Its architecture is built solely for machine learning, eliminating unnecessary transistors. The results of this architectural difference are striking. In AI inference, a critical workflow, Google's 4th-generation TPU has 30% lower latency than Nvidia's H100. This means faster response times and smoother user experiences. But that's not the most damaging. For balance sheets, the real killer is cost. Deploying TPUs on Google Cloud can reduce operational costs by up to 25%. Let's quantify that 25%. For giants like Meta, OpenAI, or Microsoft, which burn billions annually on compute infrastructure, a 25% cost reduction isn't an option. It's a fiduciary duty. It means hundreds of millions of dollars shift from costs to net income or get reinvested in R&D to hire thousands of top engineers. This is a structural competitive advantage. If your competitor starts with a 25% cost edge, it's not just a financial issue, it's a survival issue. This is the cold logic behind Zuckerberg's decision. It's not about business relationships, it's purely a rational choice based on the balance sheet. Moreover, Google is building a closed-loop feedback system that Nvidia can't replicate. Nvidia's model is hardware plus CUDA, relying on downstream customers to develop applications. Google, however, owns billions of user touchpoints through search, YouTube, and Android. It embeds the Gemini model into these products, and every click, every swipe generates real-world load data, which feeds directly into the next generation of TPU development. This creates the ultimate flywheel effect. Nvidia sells shovels to gold miners, while Google is the biggest miner itself, using its mining experience to build more efficient shovels. This application-defined hardware iteration speed is unmatched by pure hardware vendors. Financial data confirms the success of this model. In Q3 2025, Google's AI-related revenue exceeded $20 billion, with a gross margin of 68%. This proves Google not only has the technology, but has built a high-margin money-printing machine. Great investments require macro conditions to align. We must confirm the current macro climate. Over the past 24 months, Nvidia's high valuation premium was driven not just by its strength, but by the high interest rate environment. When the Fed tightened monetary policy, capital became expensive and risk-averse. In this environment, investors avoided long-term stories and chased immediate cash flows. Who provided that? Nvidia, the shovel seller. Thus, the capital flowing into Nvidia over the past 2 years was highly defensive. But the macro winds have shifted 180 degrees. In mid-November, Fed Governor Christopher Waller, a known hawk, signaled a clear policy pivot. The market reacted swiftly. Swap market pricing now shows an 81% probability of a rate cut in December. Note, 81%. In financial markets, this is no longer a probability game. It's a consensus. What does this mean? Global liquidity is restarting. As the cost of capital falls, capital becomes more aggressive and expansionary. Investors will no longer settle for one-time hardware profits, but will seek platform companies with full ecosystems, network effects, and exponential growth narratives. Imagine this. For the past 2 years, we've been in a defensive mode, all huddled in the sturdiest bomb shelter, Nvidia. Now, the storm is fading, risk appetite is rising, and capital is emerging from the bunker. It's no longer looking for shelter, but for fertile ground to build new skyscrapers. That ground is the AI application layer, and Google is the developer with the blueprint and heavy machinery. Additionally, progress in U.S.-China high-level talks has reduced geopolitical risk premiums for large-cap tech stocks. The rules of the game have changed. The market logic has shifted from defense to offense. Institutional funds are beginning large-scale rebalancing, moving from pure hardware manufacturers to platform giants. This migration is just beginning. In this grand logic chain, beyond Google itself, there's an elegant hedge: Google's TPU arms dealer, Broadcom. When Google's TPU plans first leaked, Broadcom's stock briefly wobbled. Retail investors and weak hands panicked, mistakenly believing it would hurt Broadcom. But I pointed out then, and reiterate now, that was pure market noise. The market corrected quickly. On November 25, Broadcom's stock surged 11%. Why such a sharp reversal? Because smart money completed its due diligence. They realized Broadcom isn't an outsider. It's Google's core IP and manufacturing partner for TPUs. Google doesn't produce chips. It designs them. And Broadcom provides critical custom design services and high-speed interconnect technology. JP Morgan's latest report predicts Google's TPU project will generate over $10 billion in revenue for Broadcom in 2025. This is the toll booth model on the AI highway. You don't need to bet on which car will win. Just charge every car that passes. In the gold rush, the gene seller often fared better than most miners. Broadcom is supplying the core mining equipment to Google, the newly discovered gold mine. This is institutional level play. Instead of battling in the crowded, overvalued Nvidia trade, capital is flowing to the next phase's real beneficiaries, Google and its core supply chain partner, Broadcom. The logic is closed, but as traders, we must track money flow. This is the only true test. If you only read financial headlines, you'll see retail investors shouting, "Buy the dip" on Nvidia. But analyzing 13F filings and institutional fund flows reveals a different picture. Throughout November, we observed clear divergence. Google saw consistent net inflows, while Nvidia experienced net outflows. Sovereign wealth funds and pension funds, the big players, are rotating positions. This is the calm before the storm. Retail noise dominates social media, but in the investment committees of top global hedge funds, the agenda has shifted. They're asking, where's the next growth driver after hardware saturation? Where's the alpha? Algorithmic trading is silently executing orders, shifting billions from old cycle winners to new cycle challengers. Capital has no loyalty. It only chases returns. Finally, we must address the biggest opponent in trading: your psychological biases. The human brain tends to extrapolate linearly. This is called recency bias. Because Nvidia was a huge winner over the past 2 years, your brain tricks you into believing it will always win. This leads retail investors to be greedy at the top and fearful at the bottom. I challenge you to do something counterintuitive. Exit the old narrative that made you money and enter the new one that's just starting. This will cause cognitive dissonance. While your peers discuss Nvidia's earnings, you're positioning in Google's ecosystem. They may think you're crazy. That's fine. Historically, the biggest capital returns belong to those who go against the grain before a trend becomes consensus. You've seen the macro reversal, industry logic, and money flow. Now, how do you execute? How do you position for this historic rotation? Risk management is non-negotiable. Here's a trading plan based on current market structure. 1. Conservative strategy. Focus on Broadcom. Broadcom offers exposure to Google's TPU logic with more defensive valuation. Its current P/E is around 22x, providing a solid margin of safety. Buy logic. Wait for a technical pullback to $345 near the 5-day moving average and scale in. Risk control. Set a hard stop at $330. If it breaks, the short-term trend is invalid. Exit unconditionally. Target audience. Alpha-seeking but risk-averse investors. Kettu. Aggressive strategy. Google plus Meta combo. This is a hedged offensive play. Long the supplier, Google, and the major adopter, Meta. Google, look for a buy at the $300 key support level. This is the institutional psychological line. Meta platforms, watch the $600 round number. Exit mechanism. Use a trailing stop. Let profits run, but lock in gains if the trend reverses. Never let a winning trade turn into a loss. Harom. Passive allocative strategy. If stock picking isn't your strength, the best path is to overweight tech ETFs heavily exposed to Google and Broadcom. Or look for underpriced laggards in the ecosystem, like Amazon. Set up a dollar cost averaging plan and ignore short-term noise. Remember, time in the market beats timing the market. The wheel of business evolution rolls forward, indifferent to past glories. 2 decades ago, Nokia was crushed by Apple's ecosystem. Today, Nvidia faces existential pressure from Google's full-stack ecosystem. This isn't alarmism. It's the inevitable law of technological iteration. As investors, the biggest mistake is fighting the last war. The AI revolution isn't over, but the leaders are changing. The question is your portfolio in Nokia or Apple? Are you still holding Nvidia, or are you rotating into Google's ecosystem? Review your portfolio. If you agree with this logic, prove it with trading action. We'll meet in the next trend.